Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How is it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning with us, be sure to check out all of our other content. Wherever you are listening or watching us right now, hit that subscribe button. Thumbs this video up. You know, YouTube, they deleted the ability to see how many people thumbs down your video. It's not public anymore.
Oh, good.
So they're...
because we had very high numbers of that, right?
Yeah, we did. No, we didn't.
They need to...
I actually think we had to have had one of the best ratios out there. It was usually close to 100% thumbs up.
Yeah,
it'd be like 40 up and like
I don't
no
know
down.
who'd be finding us and who would suggest it to, and then they go, "Oh, I wish it was shorter and about Bitcoin."
Yeah, no. My favorite one is like when you upload a video and like 5 minutes later, there's a thumbs down. I'm like, did you even watch it?
Yeah.
It sounds like you just don't like the way I look or something like that.
Yeah, they need to disable comments instead of disabling the thumbs down.
I know, right? Well, actually, I have the ability to do that.
Well, you can disable the comments, yeah.
But I do read the comments. People have been saying some nice things. Do you read the comments?
No. Even when I did articles, I didn't read comments.
And that's always your advice to people when they're talking about putting stuff on the internet.
People could send it to me, yeah. And I've talked about that. People are much more polite or whatever in an email. I guess they think about it more. It's not that they may have criticisms or whatever to say, but they do think about it more before sending it to you and stuff like that with an email, which is strange because, and when people, in the beginning, people started talking, when email first started, people talked about how uncivil people were with email. That could be so much more than a letter. But yeah, whereas a comment, I guess you just saw it, you pause in the middle of the video, you're angry, you type it out. You're also playing to an audience there, which is part of it, you know, instead of a personalized one where they know that email's not going to be shared, yeah.
No, funny. Anyways, in today's podcast, we are going to continue on with our Q&A series. We're picking up from December 14th, which is when I did the last call for questions, but I did say that we would come back to this, so we are going to do that right now. The first question comes from Harry, and he asks, has Geoff revisited OTCM? Prices up a lot, but so are cash flows. Also, are any overseas markets attractive to you at the moment?
Okay, we can go to QuickFS to look up OTCM. So OTCM is OTC Markets. They run the pink sheets. Now they have that thing called the expert market, the OTC, different tiers, including a lot of large foreign stocks that are on it, but also all the, the penny stocks and things like that. And they run the website otcmarkets.com, which I recommend as a place to look for these little kinds of stocks and stuff. Also
known as your second, I'd say it's, probably the second most behind QuickFS, what you go to, right? Check all your stock prices there.
SEC, Edgar, OTC Markets is where I check all my stock prices and stuff, and then QuickFS for details. Those three are the most, the websites I basically go to, yeah. OTC Markets, you can also get long-term charts and things on that. It's fairly clean and not giving you a lot of other stuff. I, of course, block all like ads.
I was going to say, those are the only three that you allow
whatever,
through, right?
So, yeah. There may be ads and things I'm not seeing. But, yeah. So, obviously, there's been a lot of froth in the market in their area of it. And as a result, they've had a lot more non-professional users. They've started to sign up some more companies. During COVID, they weren't really growing company signups. So companies sign up with them to get on these different tiers and to put information out and all that kind of thing, sort of as an alternative to being listed. And but then they also have these sort of they're like trading platforms. They're ways of communicating between investors. So that's to get information like quotes and things like that to see in depth, to see bids and asks and what different participants are putting out, but also to be able to communicate with each other and to arrange buying and selling, sort of like we used to say that a stock trades by appointment. Those are pink sheet stocks, and it's OTC how it works. So all that kind of stuff. So they have they make a lot of their money from things like Bloomberg and those things taking their data, because they obviously have the data on the prices and volume and all of that for their stocks that trade there that aren't on listed exchanges. But the thing lately has been the non-professional users has grown a lot. And so that has led to better results. If we look quarterly, we might be able to see it more. So if you, let's see. Yeah. So if we go to, let's see. Yeah, you feel like revenue growth and things like that, you may see have sped up. I don't know if you can see that.
Yeah.
Starting in the back half of 2020, you started to see more extreme revenue growth year over year, right? So it started to grow in the 20, 50, 60, 40 to 60% in the last 3 quarters or so. And that's obviously pretty extreme because they have a bit of leverage, operating leverage. So from a year ago, their operating margins went from like 30% to like 40% now. I would assume that's a short-term thing, the huge growth in non-professional. Just like crypto, cannabis, things like that are just things that happen. They go away. There'll be another fad sometime that are popular. But I think the other parts of the business are doing fine. They raised some prices on some stuff a while ago, and they're still able to get people for listings. I don't see a lot of problems that way. Stock is not super cheap, as you can see.
It's always been kind of like this, though.
Yeah, so officially it says the free cash flow is 17 times. However, they don't really use their float. They just let it sit there. So backing out the float isn't necessarily the best thing to do. If they took their float in, just put it in an index fund or something, then that would be an appropriate number to use, or if they were willing to buy back stock with that float. But they never put any debt on this business and use the float. So if we can look at the balance sheet, you could see the float. It's just a warning to people where they think they have excess cash. So you see there they have $50 million in cash. However, if we go down to the liabilities, the deferred revenue is about 20. So they only have about 30 million in excess cash. The rest of it they would consider like float, which you could use, but a lot of companies would, but I don't think they ever will.
Maybe we should send this to the CEO. He's on Twitter.
He's on Twitter. Yeah,
I'll send it to him.
Just I don't know.
DM him.
I don't know what they would do with it, of course, because if you invest in anything, it's kind of correlated to what you yourself are doing. But yeah, no, I mean, yes. If you look over time, how much has the float grown? So deferred revenue was not a big. Oh no, we're looking at quarterly.
Yeah. Just say well.
Yeah, I would have expected. There we go. So it's got deferred revenue was 4 million 10 years ago, and now it's 20 million. We just said.
Yeah.
Something like that.
Mm-hmm. Yep.
Oh,
exactly.
there's 2.
So it's 4 million
actually, there's some deferred revenue that's long-term deferred. I didn't realize that, but it's so minor. I don't know why that's happening. They do a calendar year thing, so maybe if it falls just outside the calendar year, someone could have signed up for like 13 months.
Yeah, but from 4 to 20.
Yeah. So from 4 to 20. So your float quintupled, in 10 years. That's not bad. But that's 16 million of a source of funding that you have. If you had invested that 16 million in something like an insurance company would or whatever, you might have gotten better results from that. It's not a big deal. I did the math one time. It's not some huge thing. I could do it in terms of what their earnings would be higher. If we can see. If we go to the income statement, we could probably see. Earnings per share lately have been what? Yeah. So,
on a TTM basis, about $2.26.
Yeah. I mean, so obviously it's not a huge difference that you have, but if you had, 20 million that you were investing that float, they have more than that, but that's the float. And something like a stock market, obviously, then you'd be getting about 2 million from that. Then we see that their shares out are 12 million. So obviously, you take 2 million divided by 12 million, and you factor that out, and you would see that, pretty soon it would be the point where what would they be making, like 10 cents or something like that extra per, their book value would be going up by like 10 cents. And of course they have 30 million extra in cash. It's just something to think about, whatever. Their cash is not being used.
Clip it, send it to him. Just kidding.
Which is fine. But anyway, so because of that, the free cash flow I think is a little misleading, the EV to free cash flow. However, they are extremely free cash flow generative. I agree with that part of it. So I don't think they are as cheap as the EV to free cash flow suggests. Just warning people that I don't think they're going to use all of their cash to buy back their stock or something. They could do that. Obviously, I'm sure that, they're getting to a size where they may get a call from someone. How about we, borrow, 3 times your EBITDA, add it with the cash you have on hand to buy back, a huge amount of your company's stock or whatever. Because they're pretty consistent business and stuff. But I also think the PE is a little misleading. They are more cash flow generative, and there are qualities that they have that are better than your average company. They convert more of their reported earnings into free cash flow, basically. And so as a result, I don't think the stock is really trading at 26 times earnings. But I also don't know that you can be so sure it's trading at like 18 or whatever, 17, we said the EV to free cash flow. So it's in that neighborhood. In today's market, I think you're getting a better than average business to me, more predictable than average, more of a moat than average, at an average multiple for today's market. Now, an average multiple for today's market is not the average multiple that they've been at all times. I will admit this company is trading for more than 15 times earnings, which is probably about the average if you go back, 100 years or something that stocks have traded at. So you could say it's a slightly premium price, compared to history. See, for instance, you have 18 times EBITDA. That sounds very scary. 20 times pre-tax, things like that. So obviously those seem worrying. But, I don't think that you're paying a huge price, but you are paying a fancy price somewhat. I don't think you're paying much more than the average price for stocks today, but it's not low. So I don't want anyone to think this is a low value type stock. Price to sales, 7.5, EV to sales 7. That is not crazy if I think your operating margin can be 35%. Look, we bought the stock. So obviously I thought, in a year we can go back and see what year it was or whatever. But obviously that means I probably thought the operating margin of 35% wasn't crazy. So, and since I bought it, they did have a year where it went down to 30%. They changed some headquarters stuff. They did some other things. I think there was more expense stuff, to be honest, there than anything else. And then this most recent year, they were at 30%, but they'll be at close to 40% for 2021. So, if you're at 35% operating margin, you can afford to pay 7 times sales. I'm not saying it's a value stock, but I'm saying that's actually 7 times sales is appropriate for a stock that has a 35% operating margin because, of this quality. This is something with no assets. We do need to, if you're not watching this on video, this is important. Then I'm not saying go out and buy all 25 times PE stocks, but this is a stock that has had a return on invested capital of what, and return on equity is really what we should use. So return on equity is even including the fact that they have excess cash. 40 to 100% or something like that. I guess they had a year where they had 30 or something like that. But in recent years, they've been at, officially the return on equity was 85%, 108%, 88%, 98%.
Very high.
Yeah, that's high. So with no debt and some cash, some excess cash. Yeah.
And ran by what you would probably call an owner operator.
Basically founder, refounded the company. Yeah. Yeah.
And he owns how much of the stock? A good amount.
A huge amount, actually. Yeah. Yeah, and given how little the stock trades, it's not going to be sold or anything unless he wants to sell it.
Let's see. Is it 2022 yet? It sure is. Let's see.
So they're guessing how long it would be before they could get on.
Yeah, maybe.
Yeah.
Is from Vetla. Baba is looking cheap. Also 50% lower than when Munger bought. Thoughts?
Well, we could go look at it now.
And then he said, also, have you looked at any Asian Graham type deep value stocks recently?
I do. So I have the Japan Company Handbook. I do get that. And not get it. I buy it each quarter. But so I did look through that and stuff. So that's thousands of Japanese stocks, and some of them are interesting. And I've looked at some other stocks, including I'd say there's maybe one Chinese stock that I've looked at seriously. And people know that I'm not likely to invest in a Chinese company. So, there's some things are interesting.
What has kept you from investing in the Chinese stock? Everything that we've always talked about.
Liquidity and can't see management, basically. Yeah.
Got it.
Definitely can't see management now with COVID, but it, obviously, in general, seeing management of a Chinese company and understanding what you're getting out of and stuff would not be great. So that happens a lot with a lot of companies that we look at. Not all of them. Sometimes it's very clear, but sometimes my question is, what exactly is going on here with the management? What are their plans? How do they think about things? Just need a little bit of a feel for that, and that's hard to get with the barriers that you have. Not so much language barrier. They're very fluent in English and stuff, but yeah.
Okay. Baba.
Yeah.
Alibaba.
I don't have any comments on this really. Here's the thing. So we can look at it at quick FS. There are a few things to note. This business is obviously changing a huge amount. And people who know what they're doing would understand that. It has a very strange financial pattern, almost unprecedented among large companies and stuff, large successful companies, in that it has rapid revenue growth, very rapid, and not materially slowing, although it has in the most recent period and is expected to in the next. But very strong revenue growth combined with strongly deteriorating gross and operating margins. That is unusual. It is a common feature of companies like headed for bankruptcy and stuff like that, actually, is asset growth with worsening returns on that. However, all the returns here are adequate if you do them on a marginal basis. And I've done that. I've calculated them on some things. So what I mean on a marginal basis is, for instance, you see operating margins and things like that, gross margins. But you have to take into account that the decline in it over time means that the revenue that they've added is actually at an even lower margin. So for instance, if you had a 45% margin, you went to 41%. For most companies, that's easy to calculate. They barely grow in any one year. So the change in the margin is very similar for the average company as the marginal margin. So the marginal margin is very similar to the average margin. However, or I should say the margin on the gross margin on incremental business, if you want to call it that way, because I don't want to keep saying margin all the time. So what is the incremental business one here? Well, they grew 51%. So for instance, on their revenue shown here, you go up by almost 40 billion or something. What was the margin on that 40 billion? Well, the margin on the 40 billion has to have watered down the 45% margin that it had a year or two ago gross. So that means we're talking about something closer to like 38% or whatever. You can get a calculator and figure it out for yourself on the amount of margin that you're making. Actually, it's even lower than that. So you're considerably lower margin on that. And the same thing with the operating margin. I believe the incremental business for the operating margin in the last year or so is probably around 9. So if you look, they went from an 18% operating margin down to 12.5. Now, incremental operating margin is kind of a weird concept because really gross is more helpful, but whatever, we'll use this. So if you think about it, the business that they're adding lately, if you just imagine that the business that they had last year continued this year normally, then and assume that any deterioration in the margin is due to whatever they've added, then all their new business only has like a 9% margin. Now, a 9% margin is actually okay. And it's not bad for what you pay for this stock, and it's not bad in terms of like returns on equity and stuff like that. It's okay. But it's very unusual. And it does make you think, well, okay, so what are they doing? They could be getting into totally different businesses, which is the obvious one, that have different characteristics and maybe don't look as good on an accrual basis, but are better in other ways. That's one possibility. Other possibility, though, is that there's like additional competition and that other companies that they're competing with in these things also are showing the same characteristics, which would be bad if that happened. As an example, you want to do Tencent?
Sure.
So I could show that this is not a characteristic common to all large Chinese companies like this. All right. So Tencent, you can see, has margin characteristics and stuff, while not amazing over time, are a little bit more in line with what you see from like... if I compared it to like a U.S. internet type companies like a Google or Facebook, or if I compared it to like an Activision or something like that, they would have similar sorts of characteristics. A bit wobblier maybe for Tencent, and I don't know if that's because we're capturing other things in here, other businesses, whatever, than you get from with the U.S. things. But still, it's not a constant decline that's as extremely bad. However, it is a pretty constant decline. In recent years, the operating margin has gotten pretty good versus the gross margin. So in other words, the SG&A type aspect to it is not bad. But it doesn't...
Normally, I feel like you see these things get better with scale.
Yes. Now, I don't think Google has gotten better with scale, right? Alphabet. I think over time that they have somewhat not, right? So let's see. So their gross margin, somewhat deteriorated over. Yeah.
Somewhat not.
Right. Very minor. Yeah. Very minor. But still, they managed to get their operating margin down from 32 to 22. Yeah. Facebook is less. If we do Facebook, what are they called now? Meta?
Meta.
Yeah.
Feta. No, it's Meta.
Okay. They're less so, right? They've done a better job. Well, recently it's changed, but they had shown real scale advantages. Yeah. Yeah, they grow and they're great. And I think that there are real scale advantages in the actual business, but something is happening in these companies. However, Tencent shows this characteristic of worsening marginal business over time. The new businesses that they're getting is not as good as the old, more so than Google. Google shows a little bit of that. More so true with Tencent, and then much more true with Alibaba. So, I mean, this is, so this is what I mean about how far the business had to shift. Gross margin in 2014, it's showing at 75%. It's now 41%. And I, just said that like you would expect it to actually get worse from that even. The operating margin had been as high as 40 something?
48.
And then to 12, it was 30 only a few years ago. As an example, it's been deteriorating for a while, but the huge decline that you see in the last 3 years is, normally people don't invest in a business that goes from an operating margin of 28% 3 years ago to 12 now, and is growing at 7. And in those years, grew at 41%, 29%, and 51%.
Yeah, that's
pretty unprecedented. For a company to grow that fast with seeing those levels of declines. And I just talked about before that, Amazon is quite the reverse. So early on, it didn't show that, but it's gotten better and better over time. Now, Amazon has a weird thing recently, if you look, which is they've had an incredible increase in capital intensity. So I think I calculated that Amazon is now probably has PP&E that's probably equal to the U.S. railroad industry. I think roughly true. So their actual, people say they're asset light, but actually I think they're financing about the kind of PP&E that you have with the top couple of railroads if you look quarterly. So if we look quarterly, we can see that PP&E, it's at about $200 billion or something on their books. Fully depreciated major railroads, it's not that different than that. So I expect that they will pass the major railroads industry as a whole, that there'll be more capital invested in Amazon in property, plant, and equipment than in all of railroads in the U.S. within a pretty short period. So that's odd. But we can see that in the cash flow. So, for instance, they produce no free cash flow. Allegedly, they have free cash flow in the most recent period if we go annual, the last year. But, however, that's all stock comp. So, you can see. So, trailing 12 months, they show that they have $54 million and they're spending $54 billion, and $52 billion.
Used to, smaller
companies, and $52 billion in PP&E. However, stock comp was $12 billion. So, Amazon has no free cash flow. They have negative free cash flow right now. Not a problem. I'm not against that, but that 5 years ago they had very little PP&E. It's all in very recently, the last really 3 years, 2019, 2020, and or actually it's really the last 2 years. But you do see a jump up in the last 5, and then much more so recently. So that's extreme, and we have reasons why we know that's happening. So maybe Amazon in the future will deteriorate in terms of returns on capital. That would not be surprising because they're just adding so much more capital and they're getting into tougher businesses that way. But for now, it's looking better, the numbers that we're seeing from them. However, and this is where it gets complicated. So gross margins got better, operating margins got better, but this is what I don't understand about it. All these companies are changing what businesses they're in. They're a platform or something, a marketplace, but then they use that to change into different kinds of businesses, some which are better, some which are worse. I read a couple of books on Amazon, and the interesting thing is I kind of came away after looking at the financial statements and reading those books with the idea that maybe Amazon has never succeeded in the idea it kind of originally sold investors. They originally sold investors it was going to be a bookstore, and it's been successful there. But the idea of it being an everything store itself, I think probably did not work in the US. My guess is that Amazon makes its money from books and media, which were always a great business. They were known to be a great business. They were a great business when Barnes & Noble were doing it, when Amazon was selling it early on, whatever. Any categories beyond it. So, but it also includes things like selling people digital videos, digital music. I agree. They make money on that. So we exclude, your Kindles, all that stuff. Put that aside. Actually selling products that other stores sell that are not books and media of any kind. Directly. I don't know if they make money on that in the US, and I think they don't in other countries. But what they do now is they fulfill for other parties. So they're a marketplace. They're like an eBay.
Yep.
They make money on that. And they're an advertising platform, and they make money on that. And then I've said before that, I think in the long run, Amazon, takes a lot of search from Google, because if you're thinking about a thing, you don't search Google, you search Amazon, right? Even if you eventually buy it somewhere else. I do that. I search on Amazon, learn about the product, and then I go buy it wherever I want. So, because there's just things on which Amazon can't beat the price, and it's, whatever. So it's just the same price, so there's no reason not to, but there's a lot more independent information on Amazon. So they have improving numbers those ways, but it may be because of what they're shifting from, right? So the biggest one is Amazon Web Services, right?
Sure.
So that's the biggest thing that we're seeing having a result of them. That seems to be an amazing business, right? We also know that advertising is a really good business. We know that operating a marketplace the way that like eBay does is a really good business. And probably, like I said, the books and media thing where it was originally had was a good business. So maybe what we're seeing is a lot of that shift in terms of the businesses they're in that reflects good things about Amazon. And that may be the case with these other companies, like Alibaba. It may be that's a shift from certain businesses that look good in reported earnings to businesses that don't. The argument from the investors would be these businesses that don't actually are great and will grow over time and all of that. Amazon, you have a lot more familiarity with the management and all of that. I think I mentioned the previous management of Alibaba I was not fond of. So I wasn't going to invest in the company when that management was around in the earlier days and stuff. So, but this is a very high level one, and we can't see. You're seeing the consolidated stuff of all that, and you can't see the more information on like a granular level and understand it. And I don't understand China. So my total overall from it is the momentum stuff. In business momentum, we tend to like to invest in companies where we see some business momentum, is very bad worsening. The price is good. The price versus what its price as a standalone thing right now, like without growth, is really good. And given what it'll grow at is really good and will create value. However, it's getting so much worse over time that you wonder if that'll keep getting worse and why that's happening. So it just seems from a financial statement level that it's going in the wrong direction, has been going in the wrong direction for years, worsening competition and all of that stuff, while having rapid asset growth, which is like the number one thing we avoid. Is competition's getting worse, asset growth is really high. You don't want to invest in that normally. But on the other hand, price is good and growth is good. And so it'd be projected that it would create a lot of value even at these levels if it just stayed at this level, or the level that would be worse in a year, even if it stayed at 9% or 7% or whatever margin that it could get down to.
How do you handicap that though?
I don't know how to. If it's a situation in which a bunch of companies are throwing constant competition into it and stuff, then
yeah, good luck.
Yeah, it just isn't good that way.
What do you think Munger likes about the company?
I don't know. I think he's tried to learn a lot about its position. I think that, from the outside, hearing what people say about it and everything, some companies like Alibaba and Tencent do have a strong position, similar to Amazon or something, in people's lives, and the ability to do, to be durable and to extend into other products and things like that. Sure. But there's obviously a shift in the business, just as there's a shift in Amazon's business. A lot of these things have changed a lot. I mean, it's easy to go back and look and, Google bought YouTube, but it's the same business that it always was. Facebook is the same business that it always was, even though they bought some stuff and has done some different things, but it's very similar.
If you had to pick one of the Fang stocks, which one would you be most interested in? Google?
I like all the Fang stocks, probably. The one that I'd be most sure in the long run would be Netflix. However, Netflix has a bad bargaining position. So I don't know if Netflix will make a lot of money and have a low cost of capital. So I don't know if it'll create a lot of value. It's in a much worse business than advertiser-supported media. Ad-supported media, which is Facebook and Google, is an amazing business. It's an amazing business if you're a newspaper. It's an amazing business if you're a magazine. It's an amazing business if you're a local TV station or something. And it's an amazing business for them too. But so it's just a better industry. And I like to pick ones that I think are better industries that way. But in terms of position, who has the position that's most durable in the long run in people's lives, I would say Netflix.
Do you think the industry of streaming is just going to be like 5 main companies.
I mean, others will exist, but you need sufficient scale, right? There's a lot more before, but remember they're propped up by the cable companies and stuff, which were providing the amount of scale for them to do it. But yeah, so you need a lot of scale. Most of those will go under that don't have that scale, and they'll consolidate them. And they've all been doing that, making sure that all the content is on them originally. You mentioned The Office is just a Peacock thing, right? Paramount has made sure now, I think as of a couple of days ago, that all Star Trek things, as they each roll off, will all go back to only Paramount.
You watch Yellowstone?
No.
Have you heard of that?
Yes.
That's really good. I just started it actually over the holiday.
Yeah.
It's really good.
So Paramount is a fairly weak studio. There's different like tiers to movie studios now. There's kind of Disney. So it used to be there'd be majors and there's a little bit of minor. They call mini majors. Now you got Disney above everyone else. It's in its own category. But then below that, you have that class of Sony, Warner's, and Universal and things like that. And then really now below that, you have Paramount. So Paramount is sort of dropped to that level as a movie studio. However, still a movie studio and has the streaming service and all of that. So, yeah. Same thing we were talking about with Peacock. It's certainly a weaker service and everything, but it could be that it gets in there. Yeah, no, it's not Disney Plus or HBO Max. Yeah, but it could be one of those services. Yeah, they have a big advantage over others that way.
So Netflix.
Well, but the business is really tough. Business is very, very tough. What Netflix needs to do over time, which I think they're doing, is that they have to get lots of low quality, cheap, guilty pleasure, time suck sort of things and just fill up their stuff with those, the programmer type stuff instead of high quality type things, right? And I think they will, and they know that, and they have all these things that just are based on how much time people spend on the service instead of how much they, how many awards they win and things like that. Going around trying to like buy the best movies and things, that's hard to do. A lot of these studios recently, during COVID and stuff, sold movies. Now, generally, they sell the not so good movies, the movies they know have problems with them. So, like Amazon bought the Jack Ryan movie. What did they call that one? Michael B. Jordan. I forget what it was. But they bought that one. But that obviously was one that the studio selling probably was not happy, with how it came out. And you've seen that before. Netflix, I think, was one of the ones that did it with. They bought a very production completely fell apart, went way over budget, was a disaster. Cloverfield Paradox.
Oh, okay.
Yeah. So that was one where they did 3 different movies in it, had different success with each of the other ones. Netflix was willing to buy it basically if they could advertise on, like, I think the Super Bowl was what they could advertise on or something for that one. That was one of the first ones to do that. Even though it may not have been a great movie or whatever, they were willing to pay a very high price for it because they had a name. It was attached to a few other movies. People might, sign up. They can't do that kind of thing in the future. You don't want to be doing a lot of like they did in the movie Red Notice and stuff like that sort of thing. But a lot of the, because it's a public company, people talk about it. Thunderbird Entertainment.
Okay.
Right.
Yeah.
You want to buy the stuff that they're selling, fill up your service with all that stuff.
You know what? I just thought of this. I thought it was funny. I wanted to say it. Somebody commented on our YouTube video. They said the most admirable thing about this podcast is how much of a movie nerd Geoff is and how much he knows about theaters and the industry. That was funny.
So Thunderbird says that it has high quality, entertainment and all those sorts of things, and that's fine. But basically, it produces in Canada for places that need content, to fill up a lot of time. That is fine. I'm not saying that it's bad content or whatever, but it's not. It's not prestige type content. It is to fill up a lot of time. Some of them are reality show things. Some of them are animated things. Netflix had a deal with DreamWorks to put out animated series based on their animated movies. So, give us 3 seasons of Kung Fu Panda one, give us, those sorts of things, which is kind of what Disney would do years ago. Disney would have these series that they knew how long the run would be, whether it be, 90 episodes or something like that, of let's do an Aladdin series, let's do a Hercules series, whatever, these animated series that filled up a lot of time and stuff. I think they aired like a kids block or something on Fox. I know that Fox used Pokemon and some other things then, so probably. But anyway, that kind of thing that you need. So if you have a series like that, you can entertain kids a lot. If you have your HGTV or your British baking shows and things like that, you can entertain a lot of women and older couples and things like that. So you need a lot of that stuff and a lot of reality TV and things like that Netflix will need. That stuff, a lot of it can be in-house, or you can have a few you work with like Thunderbird and stuff where the prices work out, and that can be good. I just think the actual business Netflix was originally in, of being a place to show movies by major studios, is a really tough business and not what you want to be in. You can build a business off of that, but you don't want to be trying to get the rights to Marvel,
because it's very
DC,
expensive.
Superheroes, Mission Impossible, James Bond. That's not what you want to be doing. It's very expensive, and they have all the power in that relationship, and you're going to get just like a window and stuff like that. But HBO successfully transitioned from being, home box office, being a window where you showed recent movies, to being all about series. And Netflix can do the same thing. Netflix, I think of more as a TV service, even though it's thought of as a movie thing.
Random, off topic a little bit. Why is it that some TV series, they really, get popular 3 or 4 seasons in? Game of Thrones was like that.
Game of Thrones was like that, absolutely. Very unusual, right?
Yeah.
Yeah, almost unprecedented that way. Now, one, it's on HBO, so that's a smaller number of people can watch and everything. It is way outside what most people will watch. So fantasy is not a normal category that's had large TV audiences ever.
Totally not my genre either.
Okay.
But I love Game of Thrones.
Right. And then I guess social media and all of that helped. Historically, that had been not true for TV series. So historically, TV series would peak in their 3rd year. And so you come out on a major network and stuff, the broadcast networks, you advertise it a ton, you're always going to get big numbers for the premiere. Then it drops off, and it's a question of how much it holds versus, what it had as a lead-in and stuff like that, and how many fast people are dropping off during the season and then subsequent seasons. But very rare for a TV series to keep growing after like 3 seasons. A few did and had like a resurgence, and I don't know why. I know that like originally Law & Order SVU would have had like lower ratings than the original Law & Order and stuff. And then, I don't know, 8, 9, 10 years in, it actually was still growing. Its audience started to grow, which is very unusual for a TV series. But normally, yeah, as strange as it sounds, TV series normally, after about 3 seasons, if you look at their ratings, no matter how good their ratings are, it is pretty much slightly worse each year. The novelty wears off and everything. Even if a series runs for 12 years, it may be that it was basically in decline for 9 of those. But if it started with 30 million people originally watching it and it ended with 10, then it's okay. Mm-hmm. So Game of Thrones was a totally unique situation that way. Yeah, some of course have done better in syndicate. Well, they don't, in streaming and stuff now in their later reruns. So Office did fine as a TV series. But
way more popular now.
Yeah. And there's been some that have been very strong in reruns. Some shows were very strong originally and very strong in reruns too. Like obviously Friends is one of the biggest TV shows, but also did really well in reruns. TV shows that people have forgotten, if we, could come up with some from the late 60s through the 80s and stuff. Occasionally you had top TV shows they were not very popular in reruns. I don't know why. They were just a big thing for a few years and then not that popular, where others have a lot of longevity. These streaming things like the ones that have a lot of longevity. Mm-hmm.
It's interesting when you watch a film or a TV show that was filmed, even 10 years ago, and you watch it in the present, and you're like, wow, this would never air today. Yeah. Because of certain jokes or things like that, for the fear of being canceled. That's how The Office was. The first couple seasons, I was like, whoa. Well, these jokes would upset some people.
Well, the first mini season or whatever, The Office, right, is redoing the UK Office. Yeah,
that's the worst season ever. If I'm going to tell someone to watch it, I'm like, just get through the first season, and then it, gets funnier.
I guess we could just start watching after that, right? Yeah. I wanted to say anything about Parks and Rec also they redid it after about, the first few episodes. Mm-hmm. Yeah, which is the same sort of concept. Yeah.
With the Game of Thrones, that last season, the production budget for every episode.
Yeah.
It was like a movie.
It was, and the entire first
100 plus million.
Yeah, and the entire first season of Game of Thrones was less than Warner Brothers studio pays for many movies. Certainly, first 2 seasons of Game of Thrones, probably in terms of if we add up like marketing and production and everything, each season was probably cheaper than doing a real serious Warner Brothers studio movie. So that's the trade-off they have to decide on now, because I don't know, like, we mentioned movie stuff before. We haven't followed up with all of those, but since we talked about that, Spider-Man has been a very big movie.
That was your prediction.
I predict that quarter would be big and stuff, but some other things didn't do so well. Warner Brothers movies, which are day and date, they're no longer, but they were during 2020 and 2021 on HBO Max, have done quite badly. Most recently, they're delayed. They're long after the original series sequel in a sense for the Matrix. So Matrix 4.
Did you watch that?
I did. Yeah.
It was terrible. I had no idea what was going on the whole time.
Yeah,
I was confused.
I try not to express opinions on movies, but
it was awful.
There are sometimes movies where I think it is a mistake to have greenlit them.
Yeah.
And I thought it was a mistake to have greenlit the Matrix one for a variety of reasons, including the fact that it's very hard to do a sequel so many years after. The big money, one of the categories that are huge money losers, half of them do great. But if you look at really big flops versus budget and marketing, for studios, one really big category is, I think the numbers even has a tag for it that they call delayed sequels. So we talked a little bit about, like, basically you want to put out a sequel 2 to 3 years between movies. Every 2 to 3 years you put out a movie. Like 2.5 years would be perfect. So if you got Spider-Man or something, every 2.5 years there should be a Spider-Man movie. That's the way to be long enough that people aren't like, oh wait, did a whole movie come out and I didn't notice it? They think, oh, this is the new movie. Yeah, I saw that. They keep track of it. 2.5 years, but it's not so long that people forget about it. Whereas the ones you have to be careful about are like the Ghostbusters one was a really weird one because they rebooted it with different casts and stuff, and then they wanted to go in a totally different direction. But the really popular Ghostbusters are from a very long time ago, so those are the risky ones, And Matrix is really bad that way. Whereas you're rebooting. You're not rebooting. You're doing a sequel to something a decade and a half after, and each of the subsequent 2 movies were less popular in theaters than So you had Matrix, which is the best liked. The Matrix 2 does fine on that because it has a lot of goodwill from the first Matrix. But then you see a significant drop down to the third Matrix, and you got to be careful with those. Just if people don't like a movie, you have to be very careful with doing a sequel of it. Yeah. So, the ones that work really well tend to be a movie's well liked, but our budget was too high. Let's do a sequel that costs a bit less and let's do it fast. Like those kinds of things tend to do well. Whereas the Matrix one, not so much. And it maybe should have gone straight to HBO or something with that. I don't know. It may have helped them get more HBO subscriptions. I don't know. Obviously, Warner Brothers had 2 really bad failures in the last few months because no one, even though I was not optimistic about The Matrix 4 or about Suicide Squad 2, we'll call it. I'm changing the names here just to make them clearer because the actual names are confusing. Those did really badly versus their budgets. So it's unusual for a movie that costs almost $200 million to bring in as little as those did. I don't know, but I think Matrix, the one we're talking about here, the fourth one, will end with like 50 million maybe, and it probably cost close to 200 million.
That was terrible too.
Yeah. So Suicide Squad is also not so great performance, and also probably cost a lot of money that way.
I'm sure our listeners won't be surprised to hear that for Christmas I gave you a Cinemark gift card.
Oh, Cinemark gift
there you
card.
Go. He hasn't even opened it yet. I just gave it to him in the car right over here. So there you go. Yeah. Surprise. I'm going to be your agent and get you on a couple of movie podcasts to talk about the industry. How about that? Next question.
Yeah.
How do you avoid groupthink? Especially when you're on Twitter, Value Investors Club, Microcap Club,
that's the one
Corner Berkshire and Fairfax.
You have to worry about more. I don't have to worry about groupthink because I don't really talk to groups. I don't participate with groups. Right?
One thing that I think is actually unique about you, and it's very true. To the core, I mean this when I say it, is I don't think you feel any better or worse if you're involved in a stock and other investors that you like and respect are also in the stock.
No, I've said that before. Someone asked me about that with
Like to the core, I believe that.
There was a thing where Goldman Sachs had sold something to somebody, and you remember there's a whole court case over it. But anyway, and some people were asking, well, like, wouldn't that change your opinion if you knew who was selling you the stock? And I said, I would happily buy a stock that I knew Warren Buffett was the one selling it to me. Mm-hmm. Yeah. I mean, that's the way you have to operate. That's the way you have to think.
I think it goes against human nature, though, especially, if you're a part of Twitter and all these, Corner Berkshire, Microcap Club, Focus Compounding, Value Investor Club, whatever it is. That's hard to do for a lot of people.
Right. There are a few issues. One is the rooting issue, which we have to be careful about. And even when I was talking about like movies and things like that, to try to analyze things and stuff, I do sort of make predictions and, okay, all right, I'll write this down and make this prediction. But you don't want it. But even something as little as that, people root to have their prediction be true when they don't even have money on the line. They're like, okay, I want that Matrix movie bad because I said it was going to flop.
Yeah, sure.
I want and so imagine what it's like with stocks. Imagine what it's like when you get a group of people together and you're all rooting for that. It's sort of like politics and stuff. Imagine if you got a group of people who all support the same candidate together to have a party on the night of an election. That's fine. They can do that. I would not poll them to see what the outcome is likely to be. Mm-hmm. That would be a group think that probably would not be good, what's happening there. Even if they were experts on the topic beforehand. But, if they happen to all be experts who supported some candidate and they all got together and we're all talking with each other, they're probably going to come out to an unrealistic sort of way of thinking. So I think that's hard. How do you avoid groupthink with Twitter and all those sorts of things? Because you're more involved with lots of things that...
Believe it or not, I don't think a lot of the companies that we invest in, other people are so interested in. Yeah. So that probably helps. I mean, yeah, anytime I look at a company in the early stages, I do put the cash tag in on Twitter and see if anyone else has posted research or anything like that, just to see. But I think the biggest thing that you've preached and that I try to do is to form your own conclusions as opposed to having your conclusions formed for you from other people.
Yeah. Mm-hmm. And I like all these services and there are ways to get ideas.
Totally.
Sometimes to have interesting thoughts from people on them. Yeah. I've definitely gone in a certain direction because of things people have said. Like I've looked more into something because of things people said. So it is helpful. But yeah,
and something I think about too is like, how do you know that you're not drinking your own Kool-Aid?
Absolutely.
That's the biggest.
That is a problem. We do a podcast thing, and that's a problem. Yeah. I also would like to say on that topic of not expressing any opinion about it and stuff, I'm not expressing a negative opinion about Alibaba. I don't understand it and stuff like that. I'm just pointing out something that's very unusual in the financial statements. We happen to be able to see the financial statements and I don't know much about the company. I read some book on it or something. That's about it. So when I say something like that, all I mean is literally I try to keep it to the two things that I said basically, which is it's cheap, on the current period stuff. It also has a very unusual pattern, which is you're rapidly growing while showing evidence of extreme competition or something like that, or for some reason the new businesses you're entering are extremely tough. So that's very unusual. And I try to do that with any of these things we're talking about. So I try not to be just totally positive on a stock, but say, well, here's the good things and here's the bad things, and keep that, here are the risks, and there's still risks no matter what. And not to let it shade all you're thinking about a stock. I don't know if that's the halo effect or what it is, but there's some things where if you're really positive on a stock, like, okay, the stock's really cheap. So you like the stock because it's really cheap and you should buy it. That can be very good. I try that not to let that trick me into, okay, they're probably going to use that money to buy back. I mean, we just talked about OTC markets. Yeah. Should they maybe do something with the cash? Yeah. Do I think they will? No. I still think the management's good. I don't mind the management at all. I think they're good. But I try not to let that fool me into thinking, oh, they're definitely going to do stuff with this cash. There's not really a pattern, based on their past pattern. I shouldn't expect that.
Sometimes you read write-ups and people draw those conclusions. They assume that they're going to do something with the cash. Well, but then you look at the history of management and they've never even alluded to doing anything with it.
Right. A lot of times people assume,
or that they'll sell the asset off.
Right.
Something like that.
A lot of times people assume if someone's honest, capable, owns a lot of the stock, that of course they're going to do whatever I think they should do. Because if they're smart, I mean, anyone who's smart will do what I think they should do, right? I mean, that's usually people's thinking is, I know the right thing to do. They'll do the right thing because they're smart and because they have the right incentives. And sometimes that will be true and sometimes it won't, but you got to look at the past history and all of that.
Something that I think is interesting, and it only gets proven more and more, 1 out of 10 CEOs that, we study or we talk with, I would literally say probably 1 out of 10 really understands how to create value in their stock over the long term and what that actually means.
Yeah.
And there's other ones that are perfectly, great operators, do great with their business, will continue to grow. But I really believe that 1 out of 10 probably really understand, hey, I could pull these levers to create a lot of value.
Yeah. Whereas if you read, read business management books, books for managers and they're all about books on leadership and doing this and that and whatever, which is fine. But there's basically nothing about how to make your business or your business unit or whatever as valuable as possible to the owners, even though in theory, that's one of your most important things that you're doing. And when you reach actually the CEO level, it is very much one of the most important. And it's really hard to find CEOs who think that way. Yeah, a lot of times it's accidental, to be honest. A lot of great businesses are somewhat accidental that they created as much value as they did. It happened to line up, right? Things happened to align that the way they wanted to run the business and have a lot of success for employees and for growth and for whatever things also matched up with making a ton of money for investors. But it wasn't really setting out to do that. Mm-hmm. They didn't take a hard look at it and decide on that. And for others, it was some experience that they had early on, either at a different company, that's common, or like some bad period in their industry or something that changed their thinking on it, where they're able to look back and say, oh, we didn't create value here. Oh, the stock didn't do well for a while. How do we change that?
Mm-hmm.
That sort of thing.
Mm-hmm.
But, most CEOs are in there for a few years. They don't have that kind of experience. Even though the company may have had that experience, they usually weren't close enough to the top to have seen that and had an understanding of it. So they don't have as holistic a view of it or whatever. Yeah, I agree with that. Most CEOs, not that they're good or bad, but they don't have a great idea of exactly what things inside the company drive value for the shareholders as much, even though they may have very good ideas about how to operate the company, how to market things. They have great operations and marketing ideas and stuff. Different people usually.
I think a trend over the next, whatever near term, you're going to see a lot of CEOs get on Twitter and hear from their investors.
They may.
When you do see some, certain CEOs or high-level executives involved in FinTwit, or at least kind of pay attention to what investors are saying,
right?
It does. There is a difference there.
Yeah.
And I'm not saying it's like AMC where he's, communicating like that.
I agree. You have to remember that for a lot of CEOs, except for a few institutional investors who will talk to them, they do have a faceless shareholder base. And they don't necessarily have a good idea of what shareholders want in their particular stock. And sometimes it's quite different, the base that they've attracted versus other companies. And that's one thing I don't think they ever think about. Most CEOs don't think about, even when they think, oh, I'd like a little more action in my stock or whatever it might be, or a little more attention to it. They don't think, what kind of shareholders will I get?
Oh, sure.
Yeah. And if you're going to run it like a growth company and whatever things, OTC markets, they don't need necessarily value investors in it. It would be fine for them if they had very growth-oriented, long-term compounder type people focused on it. But also, it might work fine for value investors who are interested in moats and things. But you don't want to attract a lot of short-term oriented people into a stock like that. Because, it's going to go up a lot and down a lot with the level of speculative activity there. And they're just going to say, well, that's the cycle and we're moving on. And, we'll see a lot of these kinds of cycles. And they're just the wrong kinds of shareholders for them.
Mm-hmm. I love when I see a CEO of a company or someone of one of our portfolio companies like my tweets, which are on, business related stuff. So I'm like, yes, there we go.
Yep.
Take notes. Okay.
They may have read Dale Carnegie.
Yeah. I'm being manipulated. What caught you by surprise in 2021 from an investment perspective?
Across the board, things we owned performed better as stocks than I would have expected. I would have not expected I would have expected a wider distribution of outcomes for them. And we've talked about this, and I have no idea why that is. I don't know why things did the way they did in 2020 and versus 2021, even when there weren't huge differences in business results. We've said maybe it's rotation of some things, but I also don't understand why there's meaningful sort of correlation when we're in different industries, different PEs, different whatever, towards some of the things that we own and not so much into some things that have been popular previously. I don't understand it. And there's probably finance professors who can explain it with, duration or with cyclical rotation between things or whatever, the investors' tastes and things. But it is something that's tough. I don't know why. What surprised you?
What surprised me? It was a very eventful year news-wise.
Okay.
As in things that don't actually have to do much with the portfolio. So things like with Bitcoin, GameStop.
Okay.
I think Munger investing in Baba was a big surprise for me.
Yeah, that's what surprised me.
I feel like, absent, the Fed and interest rates and all that sort of stuff. And maybe that's what I would say. The biggest surprise to me, and maybe it shouldn't be a surprise just because of what they did in 2020 and, 2021, has been the top of conversation with basically every investor I speak to is very macro nowadays.
Okay. Yeah.
What's the Fed going to do? What's interest rates? What's going to happen with interest rates? All sort of things like that. But other than that, I felt like it was a pretty normal year, I would say.
Mm-hmm. Market was up a lot.
Market was up a lot. There you go. That was a big surprise to me. Yeah, when it finished like 27%, that's a big surprise.
Yeah, that's a lot. Yeah, and so normally...
there's certain things that are very cheap that you would associate with higher inflation prints and stuff like that. That was a big surprise to me.
Yeah.
But again, I don't know. Year over year, it's very hard to predict.
So normally if the stock market goes up 27%, let's say, and that happens in a year after which it was also up, we would tend to expect to lag considerably, right? Like really considerably. And that many of our stocks almost across the board would not do as well in an environment like that. And so that's what I meant about surprising me about but of course, you can dig in and say, okay, well, yes, the S&P 500 was up by a lot, but there's actually a lot of stocks that have been pretty popular before that weren't so strong. Actually, when I mentioned last year, I think there was a surprising number of funds that were up 100%. You had your I don't know what you call them, the most innovative sorts of companies that maybe didn't have earnings and things like that, but they were cutting edge on whatever kinds of things, went up a lot. And those things didn't do so well last year in 2021. Some other things did well. And so the S&P 500 overall did well, but it actually wasn't the most, maybe I guess the most growth extreme oriented. Actually the year before had been more so that way. So maybe that has something to do with the performance of our more value things or whatever. I don't even like to call it value, just whatever our style is. I don't know what it is.
What's interesting is I think if you ask a lot of investors if you took a poll, and I'm saying this because I've seen these polls on Twitter,
okay,
the expected rate of return over the next 10 years, for example, in the market, it's all pretty low. I think people's expectations are pretty low. But then you have these massive prints.
There have been surveys we're seeing certain people on Twitter. Mm-hmm. There's surveys of the general investing public and what they expect. Or I shouldn't say general investing public, but they do surveys of all clients of a, Main Street type retail broker, discount broker. And they have really high expectations.
15 plus, 20 plus? Yeah.
Yeah. So usually they expect whatever the last 2 years or so, or, that's usually the expectations is what happens. You have a bunch of value investors following you stuff are very negative, right? So there's some people clicking 0%, 0 to 5%, whatever.
Yeah. Interesting. Here's a topic that we could do a whole podcast on. Okay. Our last 5 minutes on a stock instead of our first 5 minutes on a stock. What makes you ultimately buy or not buy a stock?
Probably management is the last 5 minutes. Yeah, management's never going to be the reason that I buy a stock in the first place, but it may be the reason I won't buy a stock, no matter how much I like it and stuff, is ultimately something about management and things like that. So I would say probably stuff like that, like management. We've visited sites of things that we've invested in. There's definitely a case where I said, I like everything here, but I kind of feel like I need to see it. Yeah. Right. I like everything here, but I kind of feel like I need to talk to the people there in some way.
Which is good to do, by the way, because if the stock ever falls or gets pretty volatile, it's good to be like, hey, this is actually a real business, like the psychological thing that comes with doing that. Also, there's commitment bias and stuff like that you got to be careful of. But I really do believe it's good to go and see a lot of the companies that you're investing in, be like, no, this is a real business.
Yeah.
They do operate. They have employees, managers.
Yeah. So for a lot of things we invest in would be like that. But of course, that wouldn't be necessary if we were investing in Apple.
No.
It wouldn't even be necessary in some other sorts of businesses that are much smaller. I can get all the information that I need from what they put out and from hearing them talk about it and stuff. But for less communicative companies, that is true. I would need to know that. For financial things, it's almost always the case. I need to have a little bit of a feel for management or culture or whatever you want to call it. Things like that. There's been some where a site visit or something is basically like, okay, so we know they're cheap and stuff. We need to see if the place is like falling apart and stuff, or if they're the kind of cheap that the customer experience is okay. It seems positive that way, but behind the scenes, they're really efficient that way, and that's what we'd like to see. We know from the financials how efficient they are, but you don't know until you set foot in it whether they're skimping on things they need to in the future and whatever, That's even true. It could be supermarkets or something. You kind of have to take a look at some of them. I'm not saying you have to see 1,000 of them if the company has 1,000, but some feel for that, because that's not really information that you're going to get, that they're behind the times and updating them and stuff. But you can get guesses about that on capital allocation from the financial statements. Most of it's the financial statements, 90% or something of it can be gathered from that and other sources online and all of that usually. But yeah, I'd say the last 5 minutes probably has something to do with management. Certainly if I liked everything about a company and then we didn't buy it, it was something about management and the direction they're heading and stuff that I just couldn't bring myself to do it.
Mm-hmm. Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. If this is the first time you are tuning in, hit the subscribe button. Check out all the content we put out there on the internet. The best place to get access to everything Focus Compounding is to follow me on Twitter, which is @FocusedCompound. We used QuickFS in this podcast to go over the financials. So if you want to sign up for QuickFS, go to quickfs.net and in the checkout, tell them that you came from Focus Compounding. Thank you so much for the support, and we will see you in the next podcast.